me begin by thanking you all for showing up. I didn't expect, or maybe I should not thank you. If nobody showed up, I could have gone back to my office. So, well, I still thank you for coming. So, well, interesting things are happening, and I don't remember when we last met what was going on. Had CSFP gone? Maybe it had gone, or not yet gone, or was on its way out. But this is a really interesting article that came out today in the Wall Street Journal, and something for us to at least pause and think about, right? And I'd love to get your thoughts on this. So basically, the article is asking, are we done? Is the banking crisis over, or is there actually more to come? And are we looking at a slow motion banking crisis? So here's the arguments that are being made, and it's worth having a conversation about it. Nicely thought out article. So it basically says that financial crises tend to be fast-moving and violent, handful of companies and countries, and usually over the weekend, and then Asian markets open up and stuff like that. So the other part, so are we done? One possibility is with the government stepping in, it's all over, peace is returned, and things will chug on from here. In fact, today there was a survey of CFOs that came out. I don't know if you saw it, that basically said they are actually looking forward to they have an upbeat 2024 lined up. So in other words, they're all optimistic about 2024, and they think that it will be a year of significant growth. That's what the CFOs think of companies. So that's a good message. That's good to hear. Doesn't mean they know anything, but it's good to hear. So another template is possible, which is the corrosive slow motion crisis, and it's interesting. So why would you? Let's think about this. Why would you think that it would be a corrosive slow motion crisis? What would cause you to think that? Or what would cause this person to think that? Or anyone? Why would you think that it's not over? The Fed thinks it's over. They might be right. Though if you Moody's just came out and downgraded based on lots of banking uncertainty. So yeah.
There's a lot of regional banks that could have the same problems as SVB. Just don't know yet.
Yeah, so well, let's think about that. They don't have the problem of catering to venture capital or to a small subset. SVB was unique in that they had unusually high concentration in one industry. But setting that aside, what else do you think could cause this? How would it unfold? Yeah.
Similar to how SVB's collaterals essentially lost all their value. If the Fed keeps increasing the interest rate, the outstanding bonds would lose their value, and then the assets of the banks might go down.
Yeah, so that's one possibility, right? If inflation doesn't abate, then you could have a situation where the Fed either keeps interest rates high or continues to increase it. If it continues to increase it and markets are still bullish and optimistic, and the recession doesn't set in, then you can have a situation that more of these, they lose more value, and there's more losses that are unrealized that are sitting on these balance sheets, right? But that is fine. Again, remember, as long as it doesn't ever become realized losses, you're still doing fine. So why would you worry? What would cause you to worry that this thing could fall apart? What would trigger another SVB kind of situation?
So I heard
Remember, just to give you some history, Bear Stearns, when it first went under in April, it took 4 months for the whole process to. Initially, they fixed it. Everybody thought it's okay. It's two funds that it ran. What are they? I forget the two funds, but they went down first. The Fed came to the rescue of Bear Stearns. Everybody thought it was okay. 3 months later, it failed. Right? Same thing happened. Then WAMU came along, and then finally Lehman in October, or in August or September, late August. So it took over 9 months in 2008 for the banking crisis to actually fully work its way through. Why do we think it's faster this time? I don't know. Why could it be slower? It's slower. Last time you could argue the Fed did not react fast enough. Here they reacted really fast, and they threw everything at the problem. They basically said we're backstopping everybody. It's no holds barred. They did things that they hadn't done historically, and so you can argue that they've actually stemmed the bleeding.
I heard that the floating mortgage assets are in trouble. I just don't know how big is that floating asset class, like across these banks. Like I heard like commercial, like commercial buildings are in trouble because of this problem. It's just we haven't seen it yet.
Yep. So that is one source of potential rot in the system. So far it's all been about interest rates, right? Historically, as I said, historically banks have gone under because of credit losses. 2008 was a credit loss problem because the housing market collapsed. So a lot of the mortgages that they carried, the mortgage-backed securities, the CDOs, the CMOs, the collateralized mortgage obligations, debt obligations, all of those lost value. They were carrying it on the balance sheet. So because of credit losses, they went out of business. That's how it's historically it's worked out. This is an interest rate problem, right? So one of the hidden places that people have to worry about right now is commercial loans, commercial real estate. Commercial real estate is seemingly in trouble. I don't know if there's a lot of anecdotal stories. If you go around and look at what's happening in commercial real estate market, just today I was talking to somebody who's in that industry, and he was saying in New York City there's somebody who owns 4 buildings or 5 buildings, commercial real estate, and what's happening is Class A buildings are Class A buildings are going at Class B rents right now because they're desperate to get the thing occupied, and so the Class B buildings are wondering where to go, what to do, and so they're actually handing over the keys to the bankers and walking away and saying it's just not worth it because they have to spend so much money to get it up to compete with the Class A's that it's just not worth their money, and so they're just walking away. So if things like that gather momentum and it becomes a real problem, then you have a bigger issue, which is not just the interest rate problem, but also a credit problem on the balance sheet of the banks. But there's more happening. Sorry.
Yeah, I was just gonna add, I think there's really nothing stopping this from getting worse. In reality, if you think about it, the whole banking system is kind of predicated on the fact that depositors put their money into the banks, and the banks then loan it out in order to get the loan interest rate, right? If everybody wanted to withdraw their cash, they could, and the banks would kind of be caught in a bind. They wouldn't be able to liquidate the assets they had on hand, or be able to surrender, justify, or make whole the depositors in that time. And the federal government is going to be limited to the amount of banks that they can then backstop to bail out.
Mm-hmm.
So I think probably the better situation would be is if we have a situation where we revisited the FDIC limits for depositors, because I think that number they created like what the Great Depression, the $250,000 limit.
No, it was raised. It was raised. It was much lower. It was 100 and something thousand.
Right. I don't remember the last time.
It was raised, I think, during the crisis, 250.
To 250, right?
Yeah.
But at the same time, the business, that FDIC limit is applicable to both retail depositors and also commercial entities as well. And I'm almost wondering if there's a situation where we have to raise the FDIC limit in order to pacify.
Do you think that will resolve the problem?
I think it would help to prevent businesses that have large deposits from pulling their money out, because I don't think the issue is retail investors, retail consumers pulling out their money en masse. I think it's an issue with businesses that makes that effort pulling out their cash.
Do you agree with that? Yeah.
I read like because people they're worried about the moral hazard thing, because it's now the fact that basically saying that they're gonna insure like over the 250,000 limit, and then because of moral hazard, like the depositors could move their deposits to the banks that essentially offer the highest interest rate, and those are the banks that
Taking
are
the most
always
risk.
the riskiest. And then when the Fed couldn't do it because of political pressure of bailout or anything, they would soon realize it, and they could like be more severe things than the SVB.
So that's an argument for why not to raise it, and the question is how much to raise it. We have come up with the number 250,000 from somewhere, right? So it can be 300,000, it can be 500,000. There is some number. Question is, can you unlimited do it? Then you, at what point does it become a serious? At what point does it become the taxpayer is on the hook for all these losses when it happens? If it's unlimited, that's what ends up happening. So like the FDIC announced that. So I don't know if you saw, but the FDIC finally sold off some of the Silicon Valley Bank assets to First Citizens of Raleigh, Durham, right? And that stock was up 50% because they sold $70 billion of assets for a discount of $16 billion. So essentially, they gave this bank a $16 billion haircut, which is wonderful for the receipt for the buying bank. But then the question, so apparently the FDIC is going to carry $20 billion of losses, which will then get paid by the banks. Other banks have to pay it through an additional charge. But they will then send it through by lower interest rates or by additional interest rate charges, either way. So to me, that's actually not going to resolve the problem. The way I think, the reason for the problem is actually more significant than what you said. It is an issue. There's no doubt about it. But there is a bigger issue, which is what? So one issue is that a lot of money has fled these smaller banks to the big banks, because the fear is that the smaller banks could go under and then the big banks are safer. So hundreds of billions of dollars moved in the last 2 weeks, right? So that's a problem for these smaller banks, because now they have deposit outflows, they have assets that are stuck. How are they going to fund it? So they're turning to the Fed on their and getting a line from them, right? But on that line they're getting charged. It's not free. Yeah.
We'll be seeing more consolidation in the near future than because of this.
We could, but the bigger question is fundamentally what are the next issues? To me, the bigger problem right now is the switch from non-interest bearing to interest bearing, even if it's in the same bank, right? Because what is happening is, and a lot of it is actually not happening with the same bank, it's flowing out into money markets. So Fidelity, they talked about BlackRock, Fidelity, and Schwab getting enormous inflows over the last few days, over the last week or 10 days. And that's because a lot of people are moving money into money market funds. And money market funds offer higher interest rates. So people have woken up. What this has done to some extent is wake up a lot of people to say, you know what, I can get some high interest rates in some other places. Why am I parking my money in a bank? There were people who were there were businesses parking more than $250,000 in the bank, right? It's not just about security, it's also how much money they were making on it. You can put it in a money market fund that's perfectly liquid and get 3.5%, 4.5% right now, 4%, depending on what horizon you're looking at, and make reasonable returns on it. So money is flowing out of deposits into money market funds, and that's a problem because now a funding source is disappearing for them. And so they're stuck with these assets. Their deposits are whittling down in two ways. Either it's going down from non-interest bearing deposits, it's switching to interest bearing deposits. And Charles Schwab, I showed it yesterday. Let me show you Charles Schwab if I can. Look at the 10K yesterday. Charles Schwab is in a bit of a trouble, right? They're talking about it because they're worried that it has a lot of okay, so okay, look at Charles Schwab's balance sheet. Notice what's happening here. Notice something interesting. So they're available for sale securities in 2021 was $390 billion. It went from 390 billion to 147 billion. Why? This is mark to market. This is available for sale securities, so it's getting mark to market. It's gone from 390 billion to 147 billion. Why?
They hold it to maturity, they don't have to realize that it's.
So what did they do?
They say they hold it to maturity and they can just have the balance sheet inflated and actually. That's it, classification.
So essentially what they did is they took 173 billion of it. That was and of this 390 they pulled out 173 billion and called it held to maturity. They reclassified it for accounting purposes. Why? Because if you reclassify it as held to maturity, you don't have to show your unrealized losses or gains. It doesn't affect your income statement or your other comprehensive income, and so you can hold it. And remember, I showed you for Silicon Valley that they had a whole bunch of losses. So the same thing. Charles Schwab has $19 billion of losses on this. and it's not showing on the balance sheet. So you can keep it at cost, at par, which is what they're doing. That's why they pulled it out, because they saw interest rates were rising and they're holding it to maturity. Now, the problem with that is the following. So it sounds good, but if you look at here, investments. So learn to read 10K. There's tons of information there. You probably never opened one. It's good to read them once in a while. It's just eye border. So much valuable information. Have you ever read a 10K? Stuff to it? No. Have you ever read some part of it? What part? MD&A. Good. That's a good place to go.
Is it a big take home?
What's that?
Is it a big take home?
Okay, well, yeah, it's useful to keep track. Anyway, so here, notice what the numbers look like. So this is the held to maturity security, and this is by duration, so when they expect it to expire. So within 1 year, they have 420 held to maturity, so they have $420 million, $5 billion that are going to mature within 1 to 5 years. 42 billion, that's 5 to 10 years, and 124 billion after that. So almost $170 billion that's going to mature 5 years and beyond. With me? On that, on average, they're earning 1.71%. Think about that. The short-term rate is what today? 4%. Right? 3.5 is the minimum. 4 is what you're looking at. So in other words, on the deposit side, they're paying 4%. On the asset side, they're earning 1.71%. You with me? So that's a spread of almost 2% that they have there. So on every dollar that they have in these assets, they're losing 2%. That's a lot. So now the question is, how good is their hedging? Have they hedged this well or not? In the case of Silicon Valley, we knew they took off all their hedges last year. Why? Because they were trying to increase their earnings. I don't know if I talked about it, but they had hedges in place. They took off the hedges in the middle of last year because the hedges were making the money, $300 million. But because their income statement was taking a big hit due to increased deposit interest rate, and they weren't making as much interest income, so they had to find earnings somewhere. They sold their hedges, their interest rate hedges, and then they got slammed after that. So really bad business all around. So the question now is how much hedging do they actually have in place, and how effective that hedging is. So to me, going back to this situation here, this one here, one of the problems that's going to come up is banks are going to face enormous pressure on their earnings. Why is the pressure on earnings? One, because the interest rates on the deposits are rising, and they're stuck on the asset side to a great extent, unless they have very good hedging. And actually, the smaller banks don't do much hedging because they don't have the technology for it. It's only the big banks that do it. And how much do the big banks do is an interesting question in itself. Then, in addition to that, if you have things like commercial banks, commercial real estate and stuff starting to implode, then you have an interest rate problem plus a credit problem, and that's two of them could come together and cause a lot of problems. That will not go away even if they give FDIC insurance, because an interest rate problem has nothing to do with it. That will just ensure that you have some deposits under that limit. But if you have a lot of money and you can make interest, if you can generate income, you'll go somewhere else to generate it, or this bank will have to pay it. So that's the income statement problem. Yeah.
I totally agree with you. My question is, in a rising rate environment like this, typically the banks win out, like they're able to lend at a higher spread.
Basically, the banks what?
In a rising
Yeah.
rate environment like this, the
Yeah.
banks are able to lend at a higher spread.
Yes.
Right, they'll make more money.
Yes.
So they need to entice the commercial depositors to typically have higher value deposit accounts to stay with them.
Yeah.
My argument would be that the federal government come in and say, hey, you're a commercial business, maybe you need these pricing metrics. We'll FDIC your deposits up to a threshold, $1 million, $2 million, whatever that is, in order to protect those higher.
No, I don't deny that at all. Yeah, it's fine. It's fine to say. I'm not saying that it's not good to have a higher limit to keep bigger accounts in place. I'm saying that's not going to solve the problem. That's going to mitigate some part of the problem. There are multiple problems here, and that will stave off one of them. I agree. But it doesn't get rid of the interest rate problem, which is actually right now a bigger problem for them, as well as the fact as to the quality of the assets. Remember, the other problem is all of these losses that we're talking about is on their investments, right? But they all carry a book. They all carry a loan book. Those loans also are losing value as interest rates rise, to the extent that the loans are fixed rate loans, like mortgages. If they have 30-year mortgages, that's losing value. So it's more assets than just the investments that we are looking at that are subject to it. So he makes the point here that from 1980 to 1994, roughly 3,000 small U.S. savings banks, loans and SNL banks is what they're called, were closed and bailed out, and that was because the Fed pushed up interest rates. This was Volcker's time, when Volcker basically had inflation had spiked, and so he raised interest rates significantly, which is what's happening right now. He raised it a lot more than what we're seeing today, so anyway, so they're basically saying that you could end up with a situation where this causes banks to stop lending. So here they're talking about commercial real estate was formed by the recession, overbuilding, collapse in oil and gas prices, emerging markets defaulted, and that caused the 2008 problem. So what else? The losses are going to mount. Small banks are particularly exposed to commercial real estate, the problem that you were talking about here. This could end up being a headache. So yeah, I think that's pretty much the gist of what's happening. Is the question that's being asked in this article, which is the real question is, we have solved the problem for now, but is this a systemic problem that's hidden away in a lot of banks that are going to come up at some other point in time in the near future if interest rates stay high? Yeah.
Do you think that this situation that we see where we're forced to cut rates because the value of those loans is so underwater that
It is such a hard decision these guys have to make. It's all going to depend on what inflation comes out as. If inflation shows signs of abating, the Fed has a lot more to work with. The interesting question is, to me, the real question is, even in a situation like that, how low is the Fed going to go? That's going to be the interesting question, because are we going to go back to the world of 0%, 1%, 2% interest rates? After the lessons that we've learned over the last, there's no free lunch. The piper has to be paid at some point, right? And right now, the belief for the last, I don't know, have you heard of modern monetary theory, MMT? What does it say? What does it say?
The government will run a deficit and just
Doesn't matter. Yeah, you can print as much money. All that matters is whether inflation comes or not, and inflation is not going to come, so they can print forever. You don't have to worry about it anymore. People used to think that was a crazy idea, and then they all became respected people in the last 3, 4, 5 years until inflation came. So the good news is that's all over and done with. That nonsense is gone. Inflation will come if you spend crazy money, right? And so the question is, will they ever go back to that world? And I think it's going to be hard for them to justify going back to a 0% interest rate, because they know all they're doing is pushing the problem up. At some point in the future, it will come to bite them again. We know it's going to happen based on what we've seen in the last 2-3 years. Yeah.
could you make the argument here that what period low rates was exacerbated by the fact that we put so much money into the economy without corresponding increase in GDP output?
Well, that's essentially
We boosted the
the
money.
putting of money is basically through debt as well, right? So debt was it's the misuse of debt. That's what happens all the time. Every crash, every recession is debt fueled,
Right.
because the growth it yields excessive growth, excessive debt in good times, and boom, everything comes crashing down, because at some point the debt has to be paid and covered. But yeah, to me there was just the belief that there's no risk. Anyway, so it's going to be much more sensitive, is what they're saying. So So this will likely hurt smaller and regional lenders more. Depositors will move their money to banks they think are too big to scale. So smaller banks lost $150 billion of deposits. I really want to see this earnings announcement. This earnings cycle is going to be fascinating for all of us, because when once the numbers come out, all the balance sheets, all the 10Qs will come out. I want to stare at a lot of these small banks and see what the balance sheets look like now. I'm sure there's a lot of stress in these banks. They've all gone. I'm sure they've gone to the Fed to borrow money, because with this much money leaving them, how do they fund the assets? You need some other way to buffer that, and they must have gone to the Fed. I'm very curious as to what the income statement is going to look like and what the balance sheet is going to look like. This next month, April, we will bring it all to class and look at that, right? Each one of you will present one bank. Yeah.
If the Fed has to fund mortgage funds, will they just raise money to do that, or they do have to?
Yeah, they will. They have the work. They have the money. It's not like $120 billion is not much. Even if they needed all of this, they can make that happen. Anyway, so here he makes this point that you're making, unless federal insurance extended to all deposits, this suggests small and medium-sized banks could be in for prolonged period of pressure on the deposits, which could in turn force them to be acquired or limit their lending. Somebody said acquisition or limit their lending. It won't be a crisis in the usual sense of the word, but the end result may be the same. So, and to add to all this, Moody's downgraded the credit rating outlook of the US banking system earlier this month. What's the point of doing that? It's like, this is after the horse has left the barn, right? Oh, yeah, I'm going to downgrade now. All it does is make an existing, it's pro-cyclical. It makes a bad problem worse. Just keep quiet. Nobody wants to hear what you have to say. Don't tell Moody's that. We have students who go there. And Moody's CEO is Johnson Alum. Yes, Moody's CEO, correct. It's S&P or Moody's, I'm trying to think. S&P, not S&P. Moody's CEO is the Johnson Alum. He's my class of 2001. Rob Fowler. Yeah, Rob Fowler. He's 2001 Johnson. The leadership team has two Johnsons. Rob Fowler and you could say Andreessen Johnson. And their head of IR is the Johnson. His classmate is the head of IR. What's her name? Anyway, he's also. Okay, anyway, so one day somebody from here will be the CEO of one of these companies. Smiling face from Johnson. Okay, so yeah, these are very interesting times. It will be interesting to see whether we are done with everything. The market nothing seems to bother the market. That's the beauty. It's like, keeps going up. It's at 4,000, and I'm going, really, are things that good for you? I don't know. Maybe it is. I could be wrong. I'm just, okay. Okay, so, I haven't said. I will finish the short selling stuff quickly, and then we talk about ETFs. And I'll walk you through some bit of how ETFs work. So we were talking about short sellers, different types of short sellers. I'm almost done here. And broadly speaking, there are two kinds of short sellers. One is the fundamental or terminal short sellers, and then you have the quant short sellers. They're different in the way they approach short selling. The The fundamental short sellers actually are looking at the 10Ks, looking at the fundamentals of the firm, looking at what competition looks like. So they're looking for things like fads, frauds, and failures. And they look at a bunch of things. So things like earnings quality, is there a lot of debt on the balance sheet? Is it a debt-driven firm? Does it have a lot of demand for cash? That usually is a very good signal. Unending appetite for cash. If you're constantly going back to the capital markets, that's a sign that the company could be in trouble. That's essentially what's happening to a lot of these growth companies today, is that they have an unending appetite for cash. This is why now there's this rush to saying, show us the path to profitability. Till now it was all a question of blitzscaling. What is blitzscaling? Have you heard the term? No? Come on, you're entering the world of technology. You should know blitzscaling, the mantra by which all of them live. Which is what? Top line growth is all that matters. I don't care whether you do it profitably or not. Just grow the top line, blitzscale. Once you get to that scale and you capture a lot of market share, then you can worry about profits. That's the way, all that has changed now. Today it's become a world of path to profitability, which is what I've always said from the start. But when money was cheap at 0% interest rate, nobody cared about it. Now everybody cares about it. Silicon Valley is gone. Silicon Valley Bank is gone. The line of credit is gone. Even more important, that you have to show a path to profit. Okay, so unending appetite for cash, obviously working capital. If you can't read it, short it. If it gets too complicated, that means something is cooking, there's something wrong, not a healthy situation, short it. I like these the most, the fads that are likely to fade. Those are the ones I love shorting. So it's just so much fun to see them fall apart because everybody loves them, and then you see it all going to naught. That's satisfying, right? Because there are no underlying economics. Think about .com stocks. There was a company called etoys.com. You may have never heard of it. It was a big noise in 2000. eToys. What did they do? They sold toys on the web, and so everybody thought it's a wonderful business, and it had multi-billion-dollar valuations. And my story was simple. I shorted it, and I was thinking, listen, they sell toys on the web. Walmart can do the same. Amazon, there are lots of companies that can do the same. And not only that, Walmart, if you don't like the toy, you can give it back to a Walmart store. So instead of shipping it back, in those days shipping back was a bigger deal than it is today. So there was no barrier to entry. Anybody could do that business, selling toys on the web. No aha. Went to zero pretty quickly. So bubble stock with no underlying economics. Today, the last 3, 4, 5 years, there's been so many of these. So many, right? And they've all gone, disappeared. The telecoms of the world. Telecom at least has some audience. There are people who like to get on it and see that it's like. At some point, my sister-in-law has been trying to give me her telecom. Why? I don't want it. Definitely you have to pay $50 to get to use it. That's like, you need the telecom, give me the subscription, then I'll take it. And I don't want just the telecom without the subscription. Anyway, so this bubble stock, fading growth stories, apparel and footwear, very standard. When you're trying to find out fads that are likely to fade, and that is one time where sequential changes are actually very good signals. So if you're identifying whether the fad is fading, one way to do it is sequential. Normally we do year-on-year changes to take care of seasonality. Remember, when you're comparing third quarter, you should look at third quarter previous year. That's the normal way of doing analysis. But the one place where that doesn't hold is if you're trying to find fads that are fading, which is where sequential changes will have value. How is it going from last quarter to this quarter? Do you see it disappear? Okay. Then of course looking for easy management, of which there's many. You can find, I gave you the example of Sutton. You can, Psycho is a very famous another example. Thematic shorting is looking for patterns, newspaper stocks, malls, great example. lots of places you can look for shorts and find them if you're willing to look. Yeah, it's very, very interesting work. If you going on the short side, it's so different and so interesting. Jim Chernow said that. He said to be a short seller, you need a different mindset. First of all, you need to be more of a pessimist. That's for starters. But you also have to have enormous ability to take abuse, take people who are saying you're an idiot, right? You have to be able to withstand, because markets on average go up. So they're constantly, people on the long side are constantly telling you you're wrong. So you have to be able to withstand that and say, you know what, as long as I have my team in place, I'm just going to stick by it. Okay, so I walked you through the Satyam example. Quant short sellers are a different group. And so they use systematic screens to identify short candidates. What does that mean? A lot of them have the same ideas, but instead of looking at them one by one, they try to make it systematic. And what do I mean by systematic? So they look for things like mean reversion. You remember economic gravity, FSA, that I talked about? The quant guys will actually look at that kind of stuff. They will say, on average, firms that have high sales growth will revert. They will revert to the mean. You cannot sustain high sales growth. The market on average seems to think that sales growth will sustain longer than it should, right? So the market is usually optimistic. So quant managers will find quant short sellers, will look for these patterns and find a systematic way of taking advantage of it. So they will use screens for it, as opposed to doing it one by one, which is what fundamental short sellers do. So they will use multiples and reversion techniques and so on. Obviously, you're looking for fundamentals that are disappearing. One of the best signals of a firm in trouble is inventory. If you see inventory building up, over and over, research has shown that one of the best signals on the balance sheet of a balance sheet that's in trouble is if you see build up in inventory, because that suggests that the firm is getting into trouble. The same is true of accounts receivable, but historically we found inventory to be the strongest of these signals, of these accruals. They're all called accruals, by the way. One of the strongest, best known quantitative strategies for finding stocks is an accrual-based strategy. And the strongest signal in the accrual-based strategy is inventory. Okay, pretty much the one other thing to note is that the two groups, so the quantitative short sellers are things like the AQRs of the world. There are so many of them, AQRs, the Renaissance Capital, all of those kind of guys. The fundamental short sellers are, examples are what? Muddy Waters, then there's the new one that did the Adani, Hindenburg. Those are all fundamental short sellers, the activist short sellers. They're actually different. Jim Chanos is a fundamental short seller, but he will short sell and not tell you what he short sold. These are activist short sellers. They short sell and then they tell the world what they've short sold. They are going to make money by telling the world what they short sold and hoping that the world, that will cause the prices to go down. That is one interesting group of people. It's the younger generation seems to belong to that more. The older guys are the ones who do it and then wait. They sit quietly and wait for it to work out. In some ways, this activist stuff makes sense. Make it happen. Put it out there. Right? Okay. So the difference between the two is holding period. What do you think the holding period difference is between a fundamental short seller and a quant short seller? Which is longer? Fundamental short sellers generally hold for longer periods. The quant guys will go in and out much faster. What about upside potential and downside risk?
Probably higher for fundamental.
The fundamental people are willing to take a lot more risk, downside risk, because there's a lot more upside potential for them. They are holding for long periods. They make their bet, they do the run work, and then they say, you know what, I'm going to stand by my thesis, right? The quant guys don't care. They're all about small amounts of money. They want to make small amounts on the upside, and as long as the downside is limited and the risk is limited. The most important difference between the two, which is not here, is in the number of holdings. On average, fundamental short sellers will hold a handful of stocks. Think about Hindenburg. They short Adani. Then they came out and said Square, which is now called Block. Block they shorted Block. They announced that they shorted Block. they probably have 20 positions at most, right? 15 positions. They do so much work on each one that the Adani position, you know the Adani thing that happened, right? That Adani position was it was a 100-page piece. So they wrote all the detailed stuff, sent people, hired a consultant. That's what they do. The quant guys don't spend any of that time. The quant guys will be in and out. So they will short 200 stocks at one time. So their basic approach, their basic mentality, right? Philosophy is make small amounts on a large number of positions. These guys, fundamental short sellers, will make big amounts on small number of positions. So the risk is also more for the fundamental short seller because if they get it wrong, they can lose a lot of money because they have big positions in it. The quant guys will have really tiny positions, 50 basis points, 1% in any given shot. So they don't really care whether the short wins or loses. You're with me? So on average, the way they think about the world, the way I think, so I'm more on the fundamental short side with a quant short side with a fundamental overlay. The way I think about the world is I take an idea. So let's say it is sales growth. On average, firms with high sales growth, their sales growth tends to revert. The market seems to have a consistent bias towards underestimating the speed of the sales growth. Let's say that's the thesis. So in other words, if I buy a bunch of firms that have high sales growth, right, as a group, they will do badly. Any one of them I could be wrong, but as a group, they will end up doing badly because the market as a group will overestimate their quality, their growth. And when it doesn't happen, prices go down. So that's the way you would think about it. So it's just a fundamentally different approach to investing. And of course, entry point is these guys are willing to enter early in the process. Quant guys usually enter later on in the process, so they have less time. Okay, I think that's pretty much all I want to say. Thanos had an interesting piece, this was 2 years ago, where he said, Thanos described the current environment. Jim Thanos, I said, is one of the great short sellers, as a really fertile field for people to stay fast and lose with the truth, and for corporate wrongdoers to get away with it for a long time. He reads of why. A 10-year bull market driven by central bank intervention, a level of retail participation in markets reminiscent of the end of the dot-com boom, Trumpian post-truth in politics, where my facts are your fake news, and Silicon Valley's fake it until you make it culture, which is compounded by FOMO, the fear of missing out. All of this is exacerbated by lack of oversight. Financial regulators and law enforcement, he says, are the financial archaeologists. They will tell you after the company is collapsed what the problem was. All in all, it's a heady vicious group of problems. So he says, doesn't believe that this market is setting up to be one of the great short opportunities of all time. Troubles coming over when that is coming. This is what he said in 2020 in Financial Times. Well, we all said it, but the problem is he's been saying it from 2012. So that's a long time to be wrong, and then you're right. Right? That's the problem. So, anyway, okay. I won't go into this long-term marketing into portfolios now if you're interested, so let me not belabor the point here. All I want, maybe what I should point out is what is the one problem with being long only is you cannot express your negative opinion on a stock, and it is limited. What you can do at best is not hold a stock. So let's say you don't like any stock you don't like. Oh, come on. Let's find something else. Tesla. Give me a more arcane stock. What stock don't you like? Really? Okay, you don't like Apple. Apple actually is one of the odd ones. Apple is 7% of the index, or 8% of the index. So you can, by not owning Apple, you can be underweight the index by 8%, right? Now, what is interesting is most stocks have a weight of less than 1 basis point in the index. 1 basis point. So if you don't like the stock, what can you do? The best you can do is don't own it. That means you're underweight by 1 basis point. Whoa! How does that change your world? And that's why being short and doing short selling can actually be a nice thing because you can truly express your opinion. And not just by not owning it, by actually going short. I'm not telling you to short, don't do it. I'm just saying that's what a short seller would say. So long only portfolio is exposed to market risk, So a long short portfolio frees the portfolio from the benchmark, allows market interest to be neutralized, and it's got all these benefits. One of the big advantages of a long short portfolio is tax efficiency, which I will now go through here. Okay. Right. Let's skip all this stuff. Here is an interesting graph. Something for you guys to think about, right? So they say it stocks for the long run. Yeah? That's the mantra, right? Stocks for the long run. Great, that's fine. In the long run, we're all dead. So what is the long run is an important question, right? And closer for me than for you. But the reality is we're all dead in the long run. So the question is, how long is your long run? That matters. This is a chart where I have the spider, the S&P 500. I have the equity market neutral index, the equity hedge index, and oh yeah, this is pi and this is the index. Okay, doesn't matter. These two should be one on top of the other. Okay, so look at what happened. This was from the peak in August of 2000. It matters. My point is, what I'm going to point out here is entry point matters. Even for people who are investing for the long run, your entry point matters, right? Why? Let's look at this. If you had bought into the S&P 500 at the internet bubble peak, this is what the S&P 500 did. For the next 11 years, it took from 2000 to the end of 2011. It crossed zero again in 2011. It took 11 years for the S&P to recover to where it was at the peak of 2000. You with me? If you were retiring between that 2000 and 2010 period, you're toast. Doesn't help you, right? This is the market neutral fund. Boring. And it finally, in 2011, the S&P caught up with the market neutral fund, the market neutral index. The message here is what? Drawdowns are very important. Protecting against downside risk is really important. You can have a huge upside, but if you have a big downside, it's all gone. Take this run, for example. This was down 40 to plus 25. That's a big run. That's the market going up almost 75%, if not more, right? Because 40 means 60, 60 went to 120, it's 100%. The market went up 100% from year to year, but then it lost all of that during the GFC crisis, right? 2008. So protecting against drawdowns is really important. The flip side to this, so market neutral strategies can take away a lot of that, or equity hedge strategies, which is the red line. The flip to that is this line here. This is the market from 2011. Look at it. Look at equity hedge strategy. Did nothing for 10 years. This is a flip of what happened in the first 10 years of the chart. Why is this happening? Any guesses? Zero interest rates. Nobody. If you ask any of the people running this stuff, they wouldn't have imagined you could have 10 years of almost zero interest rates. Very unusual stretch in history, and that's why they got destroyed. And that's why the market screamed, because interest rates are zero. Okay. How smart are the bears? Do you think short sellers on average are good at what they do? Maybe, maybe not. No? Yeah? It's more than the name, right? You're putting your money. Yeah. I don't care what happens to the name, the money. I care about the name probably more than the money, but still. Yeah. Yeah, so the answer is they're actually pretty good at it. It's really tough to figure it out. Why? Why do you think it's actually tough to figure out whether short sellers are good at what they do? Yeah.
So, like for long, like, we look at inefficiency in small caps. So, for short, are they like within like popular names that very well covered among analysts, and if every analyst knows the price, or is that more within small caps?
The short selling?
Right. Yeah.
short selling can happen at all stages. So I'll give you an example. Tesla was short sold by a lot of people. It was $1 trillion company.
So where do you see the most penetration? Is that within small cap or is that more popular?
So it's a difficult question to answer for the following reason. There is a trade-off to be made by the opportunity versus the ability to execute. So you could have opportunities in small cap, but you might find it harder to execute. You can execute it for your personal account, but you can't execute it for an institutional account. Why? You might not have enough shares to borrow. You might not be able to actually short that. And that happens a lot. And so there is a sweet spot, which is usually in the mid-cap space, where you can have the opportunity and you can execute. If it's really large cap, other than a Tesla and a few, it's harder to do it because there's just so much information out there. It's easy to short, easy to execute, but you might not have as much opportunity. That's the trade-off you're constantly doing. Okay. So the answer is yes. There is some evidence that they have abnormal returns. So if you look at firms with no short interest, they find that it has positive returns, and as the short interest increases, it has more negative returns. So on average, you can see when the short interest is over 5%, on average the normal return is negative 12%. That's what they find. More recent data, I have a paper that's right now under review that says that this number is much smaller now. Why? It's not as profitable as it used to be. It's more like 3% now instead of 12%. Why? What people doing is lots of competition. Exactly. Like everything else, it gets competed again. Okay, that's pretty much it with short selling. Let's talk about ETFs. ETFs are a fun space. Has anybody traded ETFs? Yeah? All of you have traded ETFs? What do you buy?
Low expense ratio. ETFs.
Yeah? Give me an example.
Boom. BOO.
BOO. What does it boom?
I think it tracks the S&P 500.
You think it tracks?
Oh,
Oh, it's Woo then. WEO, Victor.
V.
V.
I said
Oh,
V.
I know V. I thought BOO. That's yeah.
V's a little
So why do you use BOO and not SPY?
I don't have a reason.
Interesting. What's that? How did you come upon BOO? Hold on, what is this number? Okay. Why did you pick? How did you pick BOO?
I think I googled low expense ratio Vanguard ETF.
Oh, you put Vanguard in there. That's why.
Mhm.
Okay. Got it. Okay. So VOO is indeed the S&P 500. It's a very interesting ETF. That's why I asked you. VOO and IBB are actually really interesting ETFs. IBB is the BlackRock version of VOO. SPY is the State Street version of VOO. That's the biggest. So VOO and IBB are smaller. And when I say smaller, they're relatively smaller. I think SPY is 600 billion or something, and these two other ones are like 100 or 150 billion dollars, something like that, right? They're smaller than SPY. But I actually have some interesting insights about those two, not from your perspective. It's perfect for you. From a short seller's perspective, actually it has very different implications. It's a lot cheaper to short sell SPY than it is to short sell IBB and VOO. Surprisingly, even though they're all S&P 500 ones. And I spent some time trying to think about why that's the case. But that's not for today. I have a paper that actually thinks about why that's the case. Okay. Exchange traded fund. How many of you know what is it? How is it different from a mutual fund? No one?
It trades like a stock.
That's true or not? Yes. Good. Yeah.
Yeah, once the state can create shares, that's a fund.
So can a mutual fund. right? At the end of the, you can keep buying a mutual fund, you can sell your mutual fund share, right? What's the difference? Yeah.
If I wanna get my money out of the mutual fund, don't I have to get directly from them? I can't sell my share in the mutual fund to someone else.
Okay. Yeah. What else?
Mutual funds are more actively traded.
Mutual funds are more actively traded.
Yeah, and managed.
Oh, I see what you're saying. No, so what you mean is mutual funds trade more actively,
Yeah,
right?
yeah, by the fund.
Within the funds. Not, you and I are not trading them more, but within the funds they
Within.
trade more actively. Perfect, yeah.
Two things, ETF can be more tax efficient than mutual funds, and, ETF has much more liquidity throughout the day, whereas mutual funds, you get the closing price of the line. ETF, I can get the second price.
Okay, cool. So let's talk about these. So obviously they've exploded. I think they're an amazingly clever instrument. The first ETF was created, surprisingly not here. You know that, right? It was created in Canada. The first ETF. So it was on the Toronto Stock Exchange that it was created. And then after that, Spider was the first one in the US, the SPY. Very clever instrument. Today they account for over 31% of all trading volume as of the fourth quarter of last year. And they're about $7 trillion in AUM. So let's quickly talk about, here's the $7 trillion you can see, and you can see the growth. 2012 they were $1 trillion, they're now 7 times more in the last 8 years. Why have they grown so explosively? Because their explanation is absolutely compelling. It's really an interesting set of instruments. So fundamentally, they're open-ended funds, just like the mutual funds. Mutual funds can be of two kinds: open-ended and closed-ended. What's the difference?
Well, once you're in, you can't necessarily get out of the, your lock in your position.
Okay, and an open-end.
You can buy and sell, you can get your money out.
So closed-end fund is one that you can. A closed-end fund is one where you can buy and sell it. A closed-end fund is once you put your money into the fund, you cannot withdraw it for the life of the fund. So I'm going to try and see Morgan. I don't know if it's still there. India, IIF, still around. So IIF is a closed-end fund, right? What is interesting about closed-end funds is that the NAV doesn't have, oh, I'll come to that later. So an ETF is an open-ended fund. An open-ended fund is where at the end of every day, you can actually sell your share back to the fund or buy a new share. So money is going in and out of the fund. A closed-end fund, money doesn't go in and out. Once you put your money in there, you can trade that share in the secondary market. You with me? So IIF is an example. IIF, there are no new shares of IIF, but whatever shares exist can be traded by you and me. You with me? So there is no primary market, but there is a secondary market. Got it? Mutual fund is a situation where there is a primary market, but no secondary market. An ETF is one where there is a primary and a secondary market. So the ETF, the clever change was the ETF brought together the benefits of a closed-end fund and the benefits of an open-ended fund together. The concept is very simple, but it's very cool if you really think about it. So give me an example of a closed-end fund that we see every day.
I was gonna say private equity funds.
Private equity funds to some extent, but they give the money back too. A closed-end fund will not. Give me an example. ARK is an open-ended fund. You can go in and out, right? You can withdraw money. Yeah. Every firm's equity is a closed-end fund, right? Microsoft, You buy equity, you can't go back to Microsoft and say, give me my money back. You can trade it in the secondary market, but you can't go back to Microsoft. Microsoft can choose to give you some money back, but you can't go and demand that money back. You with me? Every firm can be thought of as a closed-end fund, essentially. Okay, so own the underlying assets and divide the ownership into shares. An ETF is created by a sponsor who chooses the investment objective. So it can be BlackRock, and the investment objective is to track the S&P 500, and they call that IVB. Or it can be Vanguard, and the investment objective is to track the S&P 500. They call that VOO. Okay, the sponsor manages the process, creates and redeems ETFs through intermediate organizations, and most are passive to the point that you just made, and they track an index. Active ETFs started in 2008. The first ETF was post 2008. They're now about $400 billion. So there's still a lot of active ETFs now that have come up. An example of an active ETF is ARK. The best example of an active ETF is ARK. Okay. This is how an ETF works. You have the ETF. This is important to understand why an ETF is so cool. So we are not allowed to deal with the ETF directly, just like we are allowed to deal with a mutual fund. We cannot do that. We deal with an ETF through what's called an authorized participant. Every ETF will tell you who the authorized participants are. On average, there are anywhere from 12 to 15 authorized participants, right? You don't need a break, do you? No, you can keep going. Okay. So, unless somebody says yes, I'm going to say assume it. Yeah? You need a break? Kate had the guts to ask for a break. Now I can't put her on the spot and say no break. Right? That's not cool. How about we take 10 minutes? Yeah? Let's take 10 minutes.